Oh, wait. What? Well, hello, all you web surfers out there today. This is the Texas Real Estate and Finance Podcast, and I am your host, Mike Mills, a North Texas mortgage banker with Geneva Financial. And do you know what the number one question on everyone's mind is these days when it comes to the real estate market? Well, whether you're a realtor, a lender, or a title rep, or even vendors that sell to everybody in the business, the number one question on everyone's mind is, when are rates coming down? We've been spinning around in this 7 to 8% mortgage rate land for the last 2 years. And I, like many of you, are really ready to put all this behind us. And today we are going to show you why our wishes are going to be granted probably pretty soon. So what I want to do is introduce you to our guest today. Now, I talk about mortgage rates all the time on the show, but today I want to reveal my secret source to all my rate knowledge and insight, because I'm just a mortgage rate novice when it comes to today's guest. So his daily updates on MBS Highway are a must watch for me each and every morning. And I am so pumped to nerd out with him today about job numbers, inflation, bonds, and the market. So please welcome to the podcast, the Executive Vice President of MBS Highway, Mr. Dan Habib. Dan, how you doing, sir?
Mike, I'm doing good, man. It's great to be with you.
Thank you so much. I appreciate you hopping on. I know you guys, y'all do this stuff every single day, which we were chatting about it a little bit beforehand about how you guys pull this stuff off. And I try to do it once or twice a week and I can barely keep up. So I'm truly impressed with the depth of knowledge that you guys give. And honestly, like, I pull a lot of my information and sources from y'all because you give so much information. I'm so excited to have you here because I really want to kind of dive into this, some of this stuff that you guys talk about each week. So right off the top, because, kind of really want to dive right into it is, when we look at where rates are right now, okay, what is it that you think, where do you think things are headed ultimately in the near future? Like, where are we going to, within the next 6 months? Are we coming back down? Is it going to come hard? Is it going to come slow? Like, what are you guys seeing just right off the top?
Well, rates have been, peskily high for quite
Mhm.
some time. And there's several factors that go into it, right? But to answer your question, succinctly, I think rates are going to start coming down.
Yeah.
But to put an exact number on it or to give you an exact timeline is definitely difficult because there's so many moving parts. But I'll tell you this: the biggest influencer, at least historically speaking, and still has a big influence today, is inflation, right? So
Right.
inflation, the definition, too many dollars chasing too few goods. It's really the rate at which the rate at which the price of goods and services is rising or falling. And we've been in the last several years a very high inflation environment. Now, the Federal Reserve has tried to quell that by hiking the Fed funds rate 5.25%. And we're seeing inflation now get a lot closer to the Fed's target of 2% on core inflation. But there's some, misconceptions out there that means that inflation is now, gone or something like that.
Right.
It's important to note that the inflation that we've seen over the last, let's say, few years, which has been over 20%, that's still there.
Right.
It's just the future rate of prices continuing to go up
Right.
has now come down in line with or close to the Fed's target. But make no mistake about it, unless you see negative inflation, the prices of goods and services aren't going to come down. They're just going to go up more slowly at what the Fed would consider like a tolerable Goldilocks rate of 2%. So that's an important thing to know. But inflation, we've recently seen rates behave a little bit more because inflation has come down. When we take a look at, the CPI report, which is one of the big inflation readings out there, the core reading, which when I keep saying core reading, that strips out food and energy prices. And that's what the real focus of the Fed is. You might say, why don't they want to look at food and energy prices? Because we spend a lot of our money on that. But the Fed wants to kind of look at what they feel they can control or influence with their monetary policy, meaning, hey, we're hiking rates. Is this getting inflation down? And food and energy prices can be influenced by extraneous things, like, let's say, geopolitical turmoil. Fed can hike all they want. If you have all kinds of geopolitical turmoil that causes the price of oil to go up, they can't really have an impact there, right?
Right.
Or you could have bird flu or bad weather for food products and stuff, right? So they strip that out and they look at the core because that will give them the best kind of like barometer on if they're getting inflation under control and if their monetary policy is working. So they have this kind of 2% target. And the Fed's everybody wants to know when's the Fed going to cut rates, right? So, the Fed has made it very clear that they're not going to wait for inflation to get to 2% before cutting, because that would be waiting too long. There's lags with monetary policy. So they want to be confident that inflation is heading there. So inflation coming down is definitely helping, and I think it will continue to come down, and that will help mortgage rates. But there's other influences out there as well. The job picture, seeing the unemployment rate go up, which we have been seeing, that certainly is going to be helpful. If we saw a recession, the economy would slow, inflation would come down, and that would help mortgage rates. If the Fed starts cutting, which we can get into when I think the Fed is going to be cutting stuff, but when they do, a lot of people think that that's going to help mortgage rates come down. Now, I will say that the Fed, they're hiking and cutting something called the Fed funds rate. That's not like they're not cutting 30-year mortgage rates, but
Right.
it can have an influence. When the Fed hikes or cuts rates, what's directly impacted is things like your short-term treasuries, your credit card rates, your car loans, and all of those have gone very, very high thanks to the Fed hiking so much. And we've also seen mortgage rates go up, but that's mostly because of inflation as well as debt, right? Which we can get
Yes.
into. But when the Fed starts cutting, you know, I don't think it's so much that the Fed's going to be cutting 25 basis points that's going to, in its own right, help mortgage bonds. But the perception is, hey, if the Fed is finally cutting rates, then we've won the battle on inflation. And if inflation continues to come down and the Fed's cutting, and now it's perceived that that's the case, that can cause the long end of yields to come down. But inflation is usually the biggest driver of long duration bonds or rates, because if you think about it, let's just say I wanted to borrow $100,000 from you, Mike, right? So, if it's a long duration loan, if inflation is on the rise, well, you're going to get a fixed rate of return every month for the next 30 years. Well, if inflation's going up, that fixed return you're getting, it can buy less and less and less and less. So, you might not be able to do anything about the loan that you gave me, but if Mike comes and or Joe comes and says, Mike, can I borrow $100,000? And inflation has gone up, the only thing you can do to kind of protect yourself from that erosion due to the inflation of your fixed return is to charge a higher rate, right? So
Right.
this is like an oversimplified example, but the bottom line is that when inflation is rising, rates go up. You have to, the investor is going to determine or require a higher rate of return to combat the faster pace of erosion due to inflation, right? But the opposite's also true, where when inflation's coming down, usually long duration rates will come down as well with it.
Right. So, one of the things that you guys talk about and you brought up just a minute ago was, when the Fed looks at what they decide to do for their Fed funds rate, they have the dual mandate. They have to have stable prices, which is the inflation number that comes into play.
Mm-hmm.
And then they have to have full employment, which is where the job numbers come into play, which is why
Right.
those are the main two metrics that the Fed is watching and looking at every single month to see where they go, determining whether or not they're going to hike, they're going to pause, or they're going to cut. Right.
Yep.
So, one of the things that I've also seen on y'all's show lately, and Danielle DiMartino Booth, who y'all did a webinar with recently, has really been on this, who's one of my favorite follows as well, is these numbers that we're actually getting from not from the Fed, I'm sorry, from the BLS, related to inflation and related to these jobs, are having massive revisions. You guys have recently talked about the birth death model when it comes to, the birth and death of businesses, when it comes to figuring out jobs. So all of these numbers have seemed to be, let's call it disingenuous or just bad data. Okay. We can, or bad, old, outdated formulas, whatever you want to call it.
Right.
So why do you think we have seen such, especially with today's technology and access to information that we have in real time as it is, do you think the Fed's relying on outdated, formulas to come up with this? Do you feel like there is any kind of, we're trying to make the economy look like it's in good shape because we're in an election year, we got to make sure everything's looking rosy? Like, what are you guys seeing on your end that you think why there's been such a disparity in some of these numbers versus what they give us initially and then the revisions that come later?
Yeah, so it's a good question. And it's one that, I don't know if anybody knows for certain as far as why the data has been so unreliable. The BLS is the ones that release the jobs report every month, which is arguably the most important report on the health of the economy that we get, which is normally the first Friday of every month and has big market implications. The Fed is making monetary policy decisions on the most important asset, the dollar, in the world, essentially based on this data. So you would hope that it's right and isn't flawed. But boy, after looking at the data for as long as I have, especially over the last like 2 years, you almost think they should drop the L in the BLS, okay? Because here,
Yes.
I'll explain it to you. So it's a hard Herculean task to come up with, an economy of our size, how many
Yeah.
jobs in net are created or lost every single month. It's not
Absolutely.
easy, right?
No.
And the BLS is trying to give you every month a pretty real time estimate as to what's happening with the labor market. Now, they have their jobs report, they have like two surveys within it. One of them is called the business survey, one of them is called the household survey. So in the business survey, what they're doing is they're looking at about 666,000 establishments or businesses across the US. And there's a lot of modeling and sampling going on there. And they also use something called the birth death ratio of businesses, which this has been responsible for the majority of the job gains that we've seen.
Right.
And it doesn't really make a lot of sense. I mean, I don't see in net so many of these businesses being created out there in this economy right now. But without the birth death model, I mean, in a lot of months this past year, you would have seen like almost no job growth. But it has been responsible for 200, 300, sometimes 1,000 job creations out of thin air. And what they're really doing with this birth death ratio is they get a lot of data from some larger businesses. They're trying to estimate what small business job growth looks like. And they don't have the resources or the data to get that. So they try to estimate how many businesses came online versus how many came offline and how many jobs that accounts for using historical numbers over the last 5 years.
Right.
Well, I mean, has there been anything that happened over the last 5 years that might skew these adjustments? I mean, obviously,
Possibly. Yeah. There's a
COVID,
few
pandemic,
events.
right?
Yeah.
So the bottom line is this: the BLS releases their headline job creation number from the business survey. And then after they release it, what they've been doing is releasing what appears to be a really blockbuster number. The market reacts negatively. You see a sell off in the bond market, but then they revise that number over the next 2 months.
Yep.
So they have their own revisions that they do, and they have been revising the numbers to the downside almost every single month. So far, just this year, the average revision is about 50,000 to the downside each month. That's a big amount of jobs. That could change materially if it's a strong report or a weak report. So last year, they overstated job growth on their own right by about 360,000, right? So you have that. Then, following many months later, you get the actual data from the census. And they look at the job numbers, and even after the BLS's own revisions, they do their own revisions on it. And this isn't 666,000 establishments. This is 11.9 million establishments. So it is the actual data that the BLS is trying to give you a real-time estimate of.
Right.
Problem is it's old now, right? I mean, the latest data that they're releasing is from Q4 of last year. I mean, here we are, about to be in Q3 of this year, right? So it's old. So the market doesn't really react, even though what the data is showing us is that even after the BLS overstated job growth in their own revisions by about 360,000 last year, the QCEW, quarterly census of employment and wages, people are estimating that this is going to show like almost 800,000 in overstatement. So, that is a really material number. I mean, essentially 1 in 4 jobs that the BLS said happened last year may not have. And then there's other revisions that have to happen based on that too, which means, when you look at the income numbers and stuff, like gross domestic income, a lot of this is based on if you have a job. But now, if all these jobs that you thought were there weren't there, all those other numbers have to get revised lower too. So I think it's showing that the economy and the job market certainly wasn't as strong as the market believed, thanks to the BLS's either inaccuracies or, listen, some people out there say that in election years there could be pressure. I don't like to get into conspiracy theories type stuff, and I certainly don't know enough one way or the other on what the influence is. But either way, the numbers haven't been good or accurate or great, right? But
Yeah.
then here's what's interesting is that, we just talked about the business survey within the jobs report, but they also have something called the household survey. And funny enough, That's where the unemployment rate comes from. So the numbers that you're seeing on the headline job creation number has no impact on the unemployment rate at all. In
Yeah.
fact, they look at the household survey where they collect the data in a different way. Now, there's not revisions to the household survey because they are actually phone calling about 60,000 households. So
Right.
based on how many people we have, how many households. I mean, it's probably like each phone call represents like 5,000 people or something, right?
Right.
And you might think that that's like, you know, gonna have a lot of inaccuracies in its
Well,
own
that's
way.
how all statistics are done. You
But
can't poll
statistics
300 million
though,
people. Yeah.
once you reach a certain size, things don't change that much, right?
Yeah.
So it is a statistically sound number, and that has its own job creation component within it. And boy, you just look at the last jobs report. One of them showed like, it's like 200 something thousand job creations. The other one showed 408,000 job losses. So the difference between their own report was like 680,000 jobs.
Yeah.
So, I mean, they're collecting the data in a different way, but that's a pretty crazy discrepancy to have within the same jobs report. One shows you lost 480,000 jobs from calling people. The other shows you gained, 200 and or lost 408,000, and the other shows you gained 280,000. Right? I mean, that's crazy.
Yeah.
But
It's
that
massive.
is where the household survey, though, is where you get the unemployment rate from, and that has been getting the Fed's attention because that was a couple months back 3.8, and then it went to 3.94. Now we're at 4.1%, highest level in almost 3 years. And to what you mentioned, the Fed has the dual mandate: stable prices, meaning 2% core inflation, and maximum employment, meaning they don't want to see their unemployment rate go too high. So, you know, in summary, on the job picture, it's been getting weaker. We've been seeing, a big overstatement from the BLS on the jobs data, but now that we're starting to get some of the revision data, it's becoming clear that job market was even weaker than we thought it was in the end of last year, and really all during last year. And so far this year, we're definitely seeing the job market cool off, and it's something that's got the Fed's radar. The Fed, if you ask me, I think they're behind the curve and they should be cutting July 31st. But
Yeah.
it seems like to me they're going to probably start cutting September 18th. And Mike, if you want to pull up picture here, I did
Well,
have a pretty
Ne-
cool.
real
Yeah.
quick, that's the frustrating part of it, is that we're in a situation where the Fed, who is ultimately the ones making the decision on when rates are going to be cut, is using data that, as based off of what we know, because I mean, in quarter three of 2023, there was, I think the number was, from the headline number to the actual number that was reported after the numbers had come in, it was like 730,000 jobs were, it missed the mark by that much. And now they're saying quarter four is going to be just as dramatic. So they're
Yeah, it
making
was 770,
decisions.
I believe, in Q3 is what the estimates were, and
Yeah.
now in Q4 it's looking, it's looking pretty egregious too. So
Well, and these decisions are being made on, because the whole idea is like, we want this soft landing. We're looking for a soft landing. Well, if you're going off of bad data and we've kept rates so high for so long, and now you're actually starting to see cracks, then it seems like, because, as you guys have pointed out many times historically, once the Fed starts cutting rates, that's when you really start to see these recessions and all this kind of stuff, that really start to kick in. It doesn't fix all the problems. That's when the economy really starts to take a dive. So that's the frustrating part.
yeah, the data's been tough to decipher though, because on one hand you'll see some signs of like big weakness, on the other hand, we started to see cracks with the consumer on spending, on retail sales, durable goods, on delinquencies and stuff. But then today's GDP number was pretty darn strong for Q2 at
Yeah.
2.8% versus the estimate of like 2%. So it's been very mixed. I think the situation our economy is in is quite a unique one because while we haven't had the referee in calling recessions, the NBER, National Bureau of Economic Research, they certainly haven't called a recession yet. Um, many economists that I talk to believe that we've been in like a consistent rolling recession where
Yeah.
different industries or sectors have been going into periods of recession, but not collectively as a whole in the economy. And you certainly could see how that could be the case. Whether if you look at manufacturing, I mean, that's been in the doldrums for a long time now, right?
Yeah.
You look at
Housing.
housing. Housing's certainly been in like a recession from an activity standpoint, right?
Yeah.
I mean, home values have still been going up, but very little activity, right?
Mortgage
So
application is the lowest in 30 years. So I mean, it's
mhm,
struggling right now.
it is. But those that are in real estate or mortgage listing, we know that one of the biggest things that will help that activity pick up will be if rates come down.
Yes.
So I think I think we're finally starting to see things work in our favor from an economic data standpoint, as well as from what I believe the Fed's going to be doing.
Yeah.
Now,
Well, speaking of the Fed, you
yeah,
had the benefit of actually going recently and attending it. Now, this wasn't actually the full Fed meeting, right? Because that was
no.
earlier.
So people aren't invited to go to the Fed meeting, but there
Right.
is like a press conference after, right? That
Yeah.
that Powell does. But this was like a public speaking thing that he did. It was invitation only, but it was at the Economic Club of Washington D.C. And somebody that I know is a member there, and they invited me to go. So it was a pretty cool opportunity, pretty kind of small crowd watching Powell speak. He was interviewed by David Rubenstein, who's kind of like his buddy. So I will say that like some of the questions were real softballs. Like I wish he would have
Sure.
asked some better questions. You know what I mean?
Yeah.
And he was trying to almost be a little comical in some cases. But like,
Yeah.
regardless, I did take away. I thought some really important tidbits from it, and I did get a chance to meet him. So I tried to rough him up, Mike. I tried to be like, "Listen, Powell, you got to cut rates July 31st."
Right.
But um, what I'll tell you what I took from it, right? So he obviously he reiterated that the Fed's not going to wait to get to 2% on inflation before cutting, and it's about how when they're confident it's getting there. But like previously, I mean, you really have to listen carefully to like the words that the Fed's choosing. One word could make a difference. And previously, Powell, as well as other Fed members, had made it clear that they didn't yet have the confidence needed that inflation was heading to their goal to cut rates. In this meeting, I thought that changed. I took some notes here on it, but he basically said that the last three inflation readings had given him more confidence.
Okay.
And he also gave a nod to the weakening unemployment rate. And he said that the labor market has cooled considerably. And he said if it weakens unexpectedly, then that could be a case for a cut, even without further progress on inflation. Although we
Didn't
are
he also
seeing,
say that he felt like the job numbers, he did state at some point, not this meeting, but previously, that he thought there was some, I don't know, remember the word you guys said he used, where it was, he didn't have great faith in that the numbers were accurate or something like that. What did he say exactly?
he what he did was he acknowledged that there was a big disparity between the
There we go.
business survey and the household survey.
Yeah.
And somebody had like questioned him on the reliability of it. And he said that, he addressed the discrepancy, but basically said these are the numbers that we have to go off of,
Yeah.
essentially. Right.
Yes.
But I think, Powell changed his tone, sounded more dovish, said he had the confidence, and also acknowledged that he was worried about the labor market weakening. And he kind of said that the thing that keeps him up at night is not waiting too long or I should say, not cutting rates too soon and then inflation coming back.
Right.
Worried about what we saw, Paul Volcker in the 70s and stuff, right? But then on the other hand, he doesn't want to wait too long and then cause a recession, because if if they waited too long, if the US goes into a nasty recession, the Fed would likely have to undo a lot of the good work that they did. I mean,
Yep.
they hiked 5.25%. They've gotten the rate of inflation down to like close to where their target is. They've reduced their balance sheet by quite a large amount, and if we saw a nasty recession, the Fed might have to cut more than they would have previously or more than they want to. They then might have to do asset purchases again. Who knows, right? So these are all things that they're trying to avoid. So, he's trying to walk the tightrope. So I don't think that the Fed is going to be cutting rates July 31st, although I think they should. But I think, there's in my eyes, 100% chance that they're cutting September 18th.
Yeah.
And that doesn't mean that that's 100% going to happen, but I think it's a lock. And
I think
if you
that's
look
the
at
general market sentiment. Honestly, I think everybody kind of feels that way. And with Powell specifically, I've always used the phrase, like, you can expect the expected. Like, there's not many situations where he doesn't tell you what he's gonna do. Like, he's pretty transparent on this stuff. I at least of all the times we've watched and seen what he's talked about, he hasn't really ever kind of strayed from, we're staying data driven. Here's our plan. The only time that I will say that I was a little surprised where he did something or didn't do something was back in December, when they announced, when the economy seemed to be doing well and everything was coming along well, and they announced and they said they were going to do three rate cuts at the end of December last year, which caused the stock market to go through the roof and everything. And at that time, I was like, what's the point of even saying that? Like, especially with all the trends that he'd done up to that point and hadn't
well,
really,
I don't know
you
that
know,
he said it, but I think he referenced the fact that, like, if you looked at their dots plot chart, right?
Yeah.
Which, the Fed, there's 19 Fed members, and they have 12 of them that vote at each meeting. And you have the Fed governors, and you have your Fed presidents at all their 9 regions, and then the Fed presidents rotate, the governors always vote, the New York Fed president always votes, the chair does too. So um, the 19 Fed members, though, they all do at not every meeting, it's like every other meeting. They do something called the Summary of Economic Projections, and they did it in December, which is what you're talking about here. And based on what's called the dots plot chart, which is where Fed members unanimously, I should say, anonymously dot or plot where they think the Fed funds rate is going to be this year, next year, the year after, in the longer run, based on where they were plotted, the median showed that the Fed was going to cut 3 times. That doesn't mean that that's what's going to happen. In
Gotcha.
fact, if you go back to 2021 and you looked at the dot plot, it would have showed that there was only going to be like a few hikes, and then they hiked 5.25%, right? So that
Right.
thing can change wildly. The market likes to talk about it and look at it, but it certainly is not an indicator of what's going to happen. And even when you look at something like the Fed futures, which right now, the Fed futures from the CME, which it's kind of like the betting line in the market as to what the market thinks the Fed's going to do. Right now, there's only like a 7% chance of a July 31st cut. That's the
Right.
next Fed meeting.
Yeah.
Then there's 100% chance priced into the market, at least,
Yes.
of a 25 basis point cut in September on the 18th. And now there's even, I thought this morning, I looked like a 12% chance of a 50 basis point cut. And then there's even a very small chance of a 75 basis point cut that's in the market now. And then they're actually pricing in now cuts in not only September, but November as well as December. So they're pricing in like 3 cuts this year now. Those things all subject to change with any data point that comes out. But, I don't, Powell, though, he's not telegraphing any date. He's being very careful not to.
Yeah.
But I think September is a lock. I don't think they're going to move in July. I think it's too soon for them. But I think things are going in the right direction now. And let's also remember, the Fed at a couple meetings ago, they made a change that most people I don't think understood, where they are absorbing some of the supply out there in the Treasury market.
Right.
One thing we haven't talked about is there's this like push-pull relationship here where on the data side of things, as far as like inflation coming down, the economy slowing, the unemployment rate going up, and the Fed who's going to start being accommodative and cutting rates soon, I think that's all good for rates. But here on the other side, something that's could work against us and provide some headwinds is just the crazy amount of spending that our government is doing.
I wanted to
So
bring that up.
we are currently spending 23% of GDP. If you want to see times in history where we've spent that percentage of GDP, and by the way, that equates it to other periods in time with the value of things, right? So it gives you like a fair comparison. You'd have to go to like the double dip recession in the 80s, the Gulf War, the Great Recession, and now.
Yeah, we're
We're not
usually
in
at
an emergency.
wartime when that's happening, not
Right.
not just in a normal economy.
Yeah, either like terrible financial disaster or wartime. And here we are spending like we're in an emergency like situation, which we're not. Even with that spending, we're still not seeing crazy growth numbers. I think without all that spending, boy, we would have seen an economic downturn much sooner.
Yeah.
As well as
Well,
the consumer has still been spending, but
that's where the GD when you mentioned the GDP number being up today, I think immediately in my head, well, how much of that is government spending on what we're doing and what's the outputs coming from? Because I mean, I'm looking at a chart right now. We've increased the debt $3.5 trillion in just 13 months since the debt ceiling was suspended, and we're very close to getting to 35 trillion for the very first time.
And here's the problem with it. The debt, the money has to come from somewhere.
Right.
And where it comes from is our treasury then issues treasuries, which is why we've been seeing record numbers at auctions. When you look at the 2-year note auction, the 5-year note auction, the 7-year, the 10-year, the 20-year, the 30-year, these are treasury auctions that happen every single month. And the numbers have been at like record highs for many of these auctions because of the spending we continue to do, the debt we continue to go into, and then the treasuries that we have to issue as a result to come up with that money. Well, that is a lot of supply that is coming to the bond market that has to be absorbed. And that, in my opinion, besides pesky inflation, which is now really coming down, that has been the reason why rates have remained so high.
Yeah.
And even though some of these other things are going to start working in our favor, I believe, I don't see us stopping the spending side of things. So that could still be a headwind for us, but you hope that the other stuff will counteract and help us. Greater than that will hurt us. So I do see rates coming down and getting better. I think we're gonna, you know, continue to see things work in our favor. I think over the next 6 months or so, it's hard again to put like a number or a
Yeah.
timeline
Yeah. No,
on
but
it, right?
there's no way to tell.
But I
Yeah.
think we can definitely get, to low sixes, maybe have a 5 handle over the next year or something if we get a little lucky. Either way, I'd be really happy with low sixes. I think that'll unlock a lot of buyers on the sidelines and such, and high fives would be fantastic. I don't think we're ever going to get, never say never, but I don't see us getting back in the foreseeable future, you know, to like under 5% or under, we're not going to get back to 2% rates or anything like that, right? But
Not unless there's a major economic event that,
right.
causes serious problems, which
But I
nobody
would be
wants.
happy with high fives, low sixes. I mean, that would, I think that would be a much healthier environment for us.
Well, I want to stay on the debt for just a second because one of the things that's surprising to me about the debt situation is that I feel like, and sometimes perception is reality. So, but I feel like in previous, election cycles, whether it be the Senate or the presidency or whatever, that whenever the debt is starting to get out of hand, the challengers, the non-incumbents that are trying to come into office, it's a high point of focus and contention. It's, when you've been in the office, this is what has occurred with the debt. When you were in control, this
Yep.
is what's happened with the debt, right? And you see that a lot. But I don't feel like right now it doesn't even seem like it's a topic of conversation when it comes to political adversaries talking about what they're better at than the other one. And to me, it's very surprising because in my mind, and this isn't conspiracy, this is just how I see it is, okay, this seems to be the biggest threat to our economy right now that very few politicians are talking about. Economists are talking about it. Jay Powell's even brought it up before when he said in his press conference, in a really nice way, like, yeah, we've got to kind of figure out this spending stuff a little bit. So what do you think? And this is your opinion, but what do you think? Why is this not a bigger focus, seen as we're in an election year and you would think both the red and the blue team would be focusing on this because it is so out of control? Why is it not being discussed? I mean, we've passed our interest on the debt is beyond what we spend in national defense. It's already surpassed that.
Over
And
$1 trillion.
very soon it's going to surpass what our Social Security spending is, which is the biggest, expenditure in the U.S. government. So why is this not a bigger focus? Why is it not on the national media stage as much as it should be?
Yeah, well, I mean, the interest alone is like over $1 trillion. That's
Yeah, it's insane.
Now, when the Fed cuts, that will help a little bit on the interest payment, but um, they did mention it, like, in the debate, but when Biden was, still running, they did mention it. But the fact of the matter is they both spent a lot, right?
Yes.
So I'm not going to get political here, but like,
No, it's both sides have done it. It's
Trump
not
spent
one or
a
the other.
lot, Biden spent a lot. I mean, I think um, no president is going to run on a ticket and be successful saying we're going to have a great reset. But
Yeah.
that's pretty much what needs to happen, right? So
Yeah.
there is no path right now to this, to getting out of the debt that we're in. We continue to deficit spend at an egregious amount, which means that, as a country, we take in taxes and we're spending way more than we're taking in taxes.
Very
Right?
simple. It's
So
not complicated.
it's pretty simple.
Yeah.
You could go to debtclock.org. It's pretty amazing. You can see in real time the debt climbing. And I don't know the answer to that problem, but I do know that, no matter if a Republican or Democrat gets in, they're probably both going to spend like crazy.
Yeah.
So I don't have an answer for that one, but it is a problem that continues to mount. Some people have talked about trying to, charge the rich more for taxes, and that's going to help, or this and that. But it's yet to be seen anybody that's going to do something. All this infrastructure spending has been crazy. I mean, this both parties, I think, are guilty of spending unresponsibly.
Yeah,
But
and the last couple of years, it hasn't, we've always since probably like, the 90s, I would say, maybe even late 80s, we've been spending more than we've made. And there's an argument to be made that because these days we're in a debt-based economy and we have an annual 2% inflation rate, that you could say that, having debt is just going to be part of the, part of the equation, right? And a certain amount of debt and deficit spending, because we can always expect a 2% increase in inflation over time. That's just how it's going to be now. Ever since we got off the gold standard, this is what we're operating under. And so, and I can understand that argument. I honestly can. But the amount that we've done just in the last 5 years
Crazy.
is just insane. And that's where you go, how is this sustainable? How do we continue? And being in the mortgage industry like I am, and you are, and dealing with interest rates and what's impacting that, and understanding how national deficits and debt impacts overall rates regardless of where the economy is, right? And then you get into a circumstance where nobody wants to get to stagflation, but there are a lot of indicators right now that say that that's not out of the realm of possibilities, where we have nobody spending in the economy with inflation still staying at higher levels, but everybody else, shutting down their spending, which is what we've seen. Then, there's a lot of concern as we move into, whoever takes over. It doesn't really matter, because it's like, how do you solve that problem? Where is the fix? And right now, it's not even being discussed. The debt ceiling conversation's pretty much it's gone, until somebody, and who's going to be the bad guy to bring that back up again and say, hey guys, everybody, we need to maybe think about spending less money, and be concerned with themselves getting reelected. So, along the inflation's not great. It's getting better. Unemployment, it's good for us in the rate world, but it's not good for the economy writ large. So, you see a lot of things kind of heading in the direction of, I don't know where the good of this comes. And although being in the mortgage industry and liking lower rates and helping people refinance is a good thing, and I want that to happen, but I also don't want our economy to completely go in the toilet as a sacrifice of that. And that's where I look at this and go, man, it seems like it's unsustainable, and I don't know where you pull this car out of the ditch.
Yeah, I mean, listen, I don't personally see stagflation as a real risk right now from what I'm looking at. I mean, geez, the
Okay.
latest numbers on Q2 GDP were 2.8%, and inflation tomorrow, at the time of this recording, tomorrow we're going to be getting the latest reading on PCE core, which is the Fed's favorite measure of inflation,
Yep.
and it's going to drop from 2.6 to probably either 2.5 or maybe even 2.4. 2.4 inflation, 2.8 GDP. That doesn't sound like stagflation to me, right?
Yep.
So I'm not really concerned about that, but
Okay.
I am concerned about the debt. You know, as long as we continue to spend unresponsibly like we are, we're going to have to continue to issue more treasuries, and that has to be absorbed by the bond market. So that can negatively impact us on the rate front, even though the other things are working in our favor, but maybe they don't come down as much as they would have without that there. But one thing that is helping with some of the supply out there is the Fed. So I think it's important to break this down, not just the Fed who's going to be cutting rates, but what they're doing with their assets. So the
Yes.
Fed, if you go back to like post COVID, the Fed wanted to stimulate the economy because we were shut down, we were in a recession, right? So what they did is they cut the Fed funds rate to zero. In addition to that, there was like 5.2 trillion in the stimulus 1, 2, and 3 checks.
Mhm.
And the Fed was buying trillions of dollars of mortgage-backed securities and treasuries.
Yep.
Every single month they were buying them. And they amassed a balance sheet of like $8 trillion or so of these assets. Now, the reason why the Fed did this is to artificially keep rates low. Now, the combination of all the stimulus, supply chains crippled, all the buying from the Fed, keeping rates at zero,
PPP.
that caught the PPP. I mean, all the spending. I mean, this created the 40-plus year high inflation, right?
Yes.
I don't know how you don't foresee that could happen based on all of that, right? But everybody thought it was transitory. I even see people addressing me, so like, see, it was transitory. No, it's not. All that inflation is still there.
It's
So
still there. It's
none
still
of
there.
it's transitory. The rate
Yeah.
has come down
Yeah.
of increase, but it's not transitory if
Home prices
the
are still
inflation is still there,
450,000 on
right?
the median. Yeah.
But getting back to the point on the Fed. So the Fed did all of this asset purchasing. It was called QE, or quantitative easing.
Right.
And by doing this, by buying all of these billions of dollars every single month of 10-year treasuries, of mortgage-backed securities, that artificially kept rates low. I mean, they were buying at least like a third of the mortgage bond market at one point.
Right.
Okay. So they then amassed this massive balance sheet, and they said, boy, we need to normalize this. So not only did they start hiking rates, they also started to allow their balance sheet to reduce every single month. So think about it like this: the Fed, based on the nature of what they have on their balance sheet, they have mortgage backed securities. So if people sell their homes, refinance, make principal payment, they receive money from those holdings. Treasuries, they mature. And they would know. So normally assets would be falling off of their balance sheet. Now, for a long time, even after they were done outright buying mortgage bonds and treasuries, they were keeping their balance sheet what's called net neutral, which
Mhm.
means that it was remaining at the same level. And anytime those assets rolled off or they received principal payments, they would reinvest them back into mortgage bonds and treasuries as to keep the same level of assets. But in reality, they are doing buying through reinvestments. So they did that for a while. And then they said, okay, we need to normalize the balance sheet. So then they started to allow up to $95 billion a month. And it was broken down 65 billion in treasuries, 30 billion in mortgage-backed securities to fall off their balance sheet. So in reality, the way this kind of works is that like, you know, it's almost like selling. It's not quite selling, but it's like they roll them over at auction and then they have to still be absorbed by the market. So that was working against us from a supply standpoint because you have all this debt coming to market. The Fed, who was the biggest buyer, now they're reducing their balance sheet and they're not buying, right? So the Fed a couple meetings ago said, okay, we're worried about global liquidity and we want to still slow down the balance sheet or reduce the balance sheet. But we think if we do it at a more gradual pace, we can do it for longer, ultimately being able to reduce the balance sheet eventually to a lower point than if we wouldn't have made this adjustment. So they said we're going to leave the mortgage-backed security runoff of up to 30 billion a month alone, but on the treasury runoff, instead of allowing up to 65 billion a month of treasuries to fall off, well, now they're only going to allow 30 billion. Or I'm sorry, uh, 25 billion. So what they're doing is they are reinvesting essentially approximately $35 billion a month in the treasury market. And at the same time, and this is through reinvestments, and at the same time, the actual treasury announced buybacks for the first time in 20 years,
Hmm.
somewhere between 8 and 9 billion a month. So, the combination of the Fed's reinvestments in the treasury market, as well as the actual treasury doing buybacks, that will help to absorb some of the supply coming to
Yeah.
market. So that's a good thing.
Yeah.
In addition to the Fed cutting, inflation coming down, maybe the economy continuing to slow. Yeah, I think the like horizon for or the outlook for rates is going to hopefully be one of trending lower, but I don't think they're going to get to crazy low levels, and we do
Right.
have the spending as a headwind still. But I think it's reasonable to think that we can see low sixes or maybe high fives if we get lucky.
Okay, so I was going to ask you. So, all right, knowing all that, and you got your bingo card in front of you. Okay, this is just Dan taking a shot at the roulette table and saying this is the number I'm picking. Where do you think, December 31st, the average like Fannie Mae 30-year fix? Where do you think it's going to be of this year and then 2025?
Boy, I mean, if I were to try to tell you with any level of certainty,
You don't know. I don't know. Nobody knows. We're just playing
but
games here.
but if we're playing bingo here, I don't know, end of the year. Well, let's put it this way. Obviously, it's different from everybody's.
We're at about 6.89, something like
Okay,
that right now on the
thank you. So
average.
you see where I was going with. Okay,
Yeah.
so you're at like 6 and 7/8 right now ish, somewhere in that neighborhood.
The average, like according to Mortgage News Daily, the average market rate right now is on 30-year fixed Fannie is about 6.89, something like that.
Yeah, so close enough to like 6
Yeah.
and 7/8. Okay,
Yeah.
so end of the year, what do you got? 6 months left here or 5 months left?
Mhm.
Um, call it 6.25.
Really? Wow. Okay. That's pretty. By the end of this year, you think we'll be in the low sixes? Okay, I like that. And then,
Optimistically.
yeah, yeah. No, hey, look, I'm with you. I love it. I hope so.
Yeah.
Okay. So then, what about? Because I think Fannie's projection by the end of this year is like 6.5 or something like that. So, what do you think by the end of 2025? You think we could be into the fives?
Yeah, I mean, I I think it's possible. I
Yeah,
think, a lot's going to depend on what happens with the economy. Are
of
we going to
course.
be in a recession? During recessions, they're not great for the economy. And I don't want to sound insensitive where, you're going to see the stock market come down. You're going to see, GDP go negative.
401ks, jobs. Nobody
You're
wants
going to
that
have
stuff.
people lose their jobs and the
Yep.
unemployment rate's going to go up.
Yep.
So none of those are good things. But
Right.
I would say a silver lining is that because of the economy slowing, inflation always comes down during recessions and mortgage rates almost always drop during recessions.
Yeah. Yeah.
So if we see a recession, which there are a lot of signs that we could see one, you know, rates could come down a little more aggressively, right? But if we can continue to have this kind of muddle through, just slowing, I think the forces we talked about will help rates to come down. But I think by the end of the year, maybe 6.25, maybe a little bit above that by next year. I hope that you can have a five handle in front of it, maybe like high fives.
I love it. I love it. That's awesome.
We'll see how those predictions work out. But like I mentioned, I'm a realist. There's so many things that could impact it that I wouldn't
I
feel
think there's
comfortable
going to
with
be a
any
lot of
level of
chaos
certainty
between now and the
saying
end
it.
of the
But
year. I think between now and the end of the year, I think things are going to be nuts for many, many reasons, and who knows where things go. I do want to talk about your show for just a minute. So, for anybody that doesn't know, you guys do your site, your company's called MBS Highway, and you guys have multiple partners, but primarily what you do is you give an update every single morning about where things are with the bond market, how things are looking regarding these job numbers and everything that we're talking about. This is something that you guys do every day. Each episode's anywhere between probably 6 to 12 minutes, just depending on how much data is out there. Y'all have been doing it for years and have continued adding to it. And your dad Barry is the kingpin of all this. Been running the show for a long time, and I've noticed over the last couple of years you're starting to work into to taking the reins a little bit, but. I want you to talk a little bit about the show, where that kind of, came from, what your experience has been like doing that, the type of feedback you guys get, because
yeah.
like I said, I've been watching it for years. I love it. You guys do a fantastic job and give a lot of really good information.
Well, thanks for that. Well, I'll give you a quick history, right? So, my father, Barry Habib, some of you guys listening may know him. He was a big mortgage producer, when he was younger. He owned his own mortgage
Mhm.
company, then worked for several mortgage companies. And, I remember at one point he sat me down and he's like, Dan, because there's a lot of smart people out there. The difference between somebody that's smart and successful is taking action and just freaking doing it, right? So he was telling me this as he was telling me about this idea that he had because he was a successful mortgage professional. He thought that there was a platform or service he could create to help other mortgage professionals by being like fiscally literate. And also, he was brought to his attention that there was like this new technology at the time. This is back going to like 2001. Okay, and it had to do with like dialers and like companies like Dial My Calls. And the light bulb started to go off in his head about being able to send text messages and alerts as to when lenders may repricing based on changes of mortgage-backed securities. For those of you that don't know, the 10 year is a good barometer for like long duration rates, but that's not where mortgage rates exactly come from. The 10 year can certainly influence the bond market and stuff, but they come from something called mortgage-backed securities, which is a bond that trades in the bond market. They are literally, pools of mortgages that are securitized, right? And if that goes up or down, that is literally what lenders are repricing based off of. So by providing live quotes to our customers, monitoring the changes, you can do a pretty good job of, if you're watching this in real time with the right resources, determining when lenders may be in a position to reprice. So,
Yes.
bottom line, 2001, Barry created a company then called Mortgage Market Guide. Back then we were just doing written updates every morning. We were doing text messages and alerts, providing live quotes and things like that. And that was the majority of the premise of the service, written updates on analyzing the data and stuff, the economic data. And it became quite ubiquitous in the mortgage industry. This was before Dodd-Frank. So, if we sent out an alert, you didn't have to pass that better rate on to the customer. Customers were making 10 grand every alert based on
Yeah.
how many loans they had in their pipeline. I mean,
Yeah.
the return on investment of the service was very easy to quantify if we helped time a few alerts good for you,
Yeah.
right? But then you had Dodd-Frank, we grew the company, we sold it. And then about 12 years ago, after having like a non-compete for a couple of years, about 12 years ago,
Those are gone, by
Barry,
the way. You saw
say that
that?
again?
The non-competes, they're gone.
Yeah,
They're as of September 1st, they're no longer valid. So
that's crazy.
yep.
So essentially 12 years ago we had a lot of people wanting us to kind of come back and create something. So Barry you know called me up and said, hey, do you want to start MBS Highway or start a new company with me? I don't know if we had the name at that point, but that's when MBS Highway, the current company, was created. And we are blessed to work with the largest banks, mortgage companies, brokers in the country. I mean, every company out there has some level of subscription with us, I'm sure.
Yep.
So We get a chance to help thousands and thousands of mortgage professionals every day to be advisors to their customers, to increase their conversion with market knowledge. And we also do a lot of stuff besides like monitoring the market and giving them insights and stuff and making them a real expert. On our site, we have a ton of data and tools. And that was really the biggest thing I think we changed from the original mortgage market guide to then MBS Highway, is we really pivoted where, listen, the alerts are still important, but not as important after Dodd-Frank. How else can we help mortgage professionals? What we did is we really spent a ton of money on analytics on data. So, on our site, you could pull up data for any zip code in the country and within a second be able to show somebody the forecasted appreciation, quantify that, historical numbers, you name it.
Yeah.
And then we've created tools to help mortgage and real estate professionals to overcome the challenges they face in today's market, right? So like if I were to outline for you like the four biggest challenges right now. Well, even though we talked about why rates are going to come down, right? Naturally, customer hears that, right? Well,
Yep.
maybe I should just wait for rates to come down before purchasing, right? So there's that waiting for rates to come down. We've created a tool called the cost of waiting because people don't contemplate that. And it's all using data for that local market. You pull it up in seconds, but people don't realize that the missed depreciation and amortization and such is going to dwarf the interest savings. And then you can always go ahead and refi later once rates come down. But, people say marry the home, date the rate, right? And that's what they're trying to say is buy the home today and date the rate and then refi later.
Yeah.
But if you don't explain it and quantify it for the customer, it's just a cute saying, right? So we help you to quantify that and to illustrate it very, very effectively and easily to show that, hey, even with rates 1% higher than if you wait a year, you're going to be $26,000 better buying today versus waiting, factoring in all the costs of dating the rate and everything else and the refi cost. Or, the media says it's better to rent than buy in every market in the country. Well, have a real mic drop argument and factor everything in and show them why you're $250,000 better buying versus renting after 9 years. Or the lock-in effect, right? We have tools to help overcome every obstacle that you could brand, co-brand, and then while your competition's out there buying realtors coffee and bagels to try to earn their business, you're creating this for their active listings and you are solving their problems. You're coming up with solutions for them and helping them gain more business. And we think that gives you a much better shot. So that's MBS Highway. But over the last year, we also purchased a company called List Reports, or a year and a half now, maybe. So List Reports, a lot of agents listening, you're probably familiar with it, but List Reports has a couple parts to it where we provide all the transaction data. So you can look up agents or LOs and see, how much business they're doing, who they're sending business to. And it's kind of like an MMI type product, but we make it actionable and send you alerts as to the best times to engage. And then the other part is a whole automated marketing platform where if you're a realtor, you can sign up for free for List Reports. And then within 10 minutes of having a new listing, you get like 25 pieces of marketing content, open house flyers, social media posts, text codes, property websites, you name it, all done for you within seconds. So it's nice and adds a lot of value too. And then we've created a new product called the Home Report, which is a competitor to like a HomeBot where you market to your past database, right? So, I think that's going to be really important because we talked about rates normalizing and like coming down a bit over the next 6 months to a year, right? Well, there's been about 10 million transactions that have happened over the last 2 years. The vast majority are going to be refi eligible once rates come down.
Yep.
Are you ready to take advantage of that opportunity as a mortgage professional? A lot of people aren't, dominating their database the way that they should be, but you need to make sure you're marketing to them right now and staying in front of them with something of value. There's some pretty amazing stats that I saw where if you do somebody's loan, if you don't market to them at all, the chances of them coming back and using you again is about 19%.
Yep.
But if you market to them with anything, that number like doubles to like 38%. But then the key is if you market to them with something of value, the likelihood triples. Right?
Yeah.
So, you need to make sure you're well positioned for what I think is going to be a big refi business opportunity over the next year or so.
Well, what you guys do that I've appreciated so much, and I think especially these days with the lack of, unfortunately, it's just the truth. There's a lot of lack of financial knowledge out there for consumers and, next generation folks coming up. And to be, an effective mortgage professional or an effective realtor, having knowledge that you can share with your clients and give them actual information and data and sell your brain, as I like to put it, as opposed to selling a rate or selling a product. You're selling your knowledge as a financial advisor, not just a mortgage professional professional or not just a realtor. And having data to be able to give them an easy access to it just makes it so much so that you're now the go-to expert for all things real estate when it comes to your clients in your database. And the tools that you guys provide, by the way, at a very, very low cost for an individual, is extremely beneficial for this type of stuff. And it's so easy to plug and play, and it's very easy to use. And you did the certified mortgage advisor thing for a while, which you're still doing, which I participated in, and you learned so much from that process, just about how all this stuff works. So when you're sitting in, it's crazy when you're sitting in a group of friends or family, and there's 15 or 20 people around, and people want to ask about rates and costs or whatever, and you can sit there and just spit out all kinds of knowledge of things that you've learned, just watching the update every day and then using these tools. It really sets you above your competition in so many different levels. And especially, into this new market where understanding how rates are going, how quickly they're going to fall, when they're going to fall, and all that kind of stuff is going to make it to where they call you first. And that's the thing that I appreciate most about what you guys do. I'm a client, I'm a customer, and I can't speak highly enough of it. It's one of my favorite tools.
Well, thanks, Mike. One thing that we didn't talk about, I know we're going to end up running out of time, but um, there was two other things we could touch on quick. One just being the housing market in general, and the other being crypto. But just real fast on housing, we talked about where I think rates are going, but I think we're going to continue to see a strong housing market from an investment standpoint, from a price standpoint. There's a lot of negativity out there in the media talking about like, home prices are going to come down. We have all this supply and da da da. I think we're going to continue to see home price appreciation. I think this year in 2024, that we're going to see about 5% nationwide. Of course, that could vary a little bit in different areas, but we just got numbers, existing inventory. We're still like right around like we're at like 1.3 million. I mean, when we were in trouble, 2007, there was like 4 million existing homes for sale.
Right.
Now we're at like 1.3 million, and that's still very tight. And you have 39 million more people than back in 2007 in the population of the US. But not only that, inventory is like cyclical, where every single year, if you look at a chart, inventory will come down and then it will start rising, and then it'll usually like stop rising in around June, and then it'll start coming down again. But it's going this way, it's going down to the right. But there's obviously little waves that happen seasonally, and it has to do with people moving, getting their kids in before the school year. I mean, that all plays a role, right? But inventory is very, very tight. And I think the tight inventory scenario gets even tighter when rates come down and you get a lot of demand coming off the sidelines. But then, let's talk about demand. Household formations is a really good kind of proxy for demand, right? And like that is like you have your family, you have mom, dad, and kid living at home in one household in a home. Kid grows of age to buy or rent a home, and he moves out. Still the same family, but now you have two households, right?
Right.
So that's a household formation, just to give you an example. And we talked about the existing inventory market, but let's talk about builders and completions, right? Well, you know, 2007 and the housing bubble and stuff, you had a lack of demand, you had a glut of supply, and you had really lax lending standards and a couple other problems. But let's start with construction. Are we at risk of a glut of supply? Well, the media will tell you that inventory's increased a lot. I just went over with you the numbers. It was from a very low number, so you got to be careful with percentages when you see that occur.
Right.
But also, most markets are like the Northeast is like 50% below pre-pandemic levels from an inventory standpoint. We have seen, in the Sun Belt, Florida and Texas, quite a bit of supply come on the market
Yes.
there. So that is true. And those areas, probably won't perform as good as others, regionally, like, from a appreciation standpoint, if there is like that glut of supply there. Right. But we have really good visibility into new supply. It's not like you blink your eyes and you get a new home.
Right.
So when we look at completions, when we were in trouble, builders were putting up like 2 million homes a year. It was like record highs. Right now, in order to build a home, you have to permit it, then you have to start it, then you have to complete it. Well, permits aren't even reaching like 1.4 million right now. And the household formations are on track on an annualized basis of like 2 million. So that's a lot more household formations than completions, right? So I think home prices should be well supported into the future. And in fact, I think if rates come down, you're going to unlock a lot of demand on the sidelines that could even propel prices higher. So, I think, the media, a lot of what's out there is garbage and fear mongering. I mean, Diana Olick on CNBC has been calling for a housing bubble for like the last like 12 years. And boy, if you listened to her and didn't buy a home, you missed a really wonderful wealth creation opportunity over the last decade, right? So I know that's the way I see housing. And then on crypto, I have a big passion for crypto. I have a company, in addition to the ones that we just talked about, one called Crypto Charged,
Mhm.
which you can just go to cryptocharged.com. And, if you want to check it out for free for a period of time, if you use my last name, Habib, it'll give you like, a free 30-day membership. And then you get 50% off when you sign, if you wanted to sign up after. But it's really designed for the crypto investor. So similar to how with MBS Highway, every day we do some education, a video breaking down the market, the macro. We look at the charts. We, break down the economic data. We do a similar type of thing, but as it relates to crypto. So breaking down the different coins and the news for the coins and, doing technical analysis, doing something that's unique to crypto, which is on-chain analysis, where you can analyze kind of investor behavior and trends and stuff, looking at the on-chain analytics because they trade on blockchain, right? Or because they're on blockchain. So some cool stuff, but really trying to give investors the education they need to make better informed investment decisions in the cryptocurrency market, which can be tricky.
Yeah. Well, on the crypto side of things, we're gonna hop off here because you're a busy guy and I want to be respectful of your time. But I will say that I feel like, and I think you would agree, that in times of possible recession, which we're what we're heading into, there
Yep.
is also a time of great opportunity, because when you look at investing in anything, real estate, crypto, the market in general, when things come down, historically they always come back up, right? And it's just a matter of time and when. So having a good knowledge base on understanding when things are going to kind of head down and maybe even get to, nobody can call the bottom, but you can get close sometimes on when you start to see things turn around, and having that knowledge and having sources that you can go to, and reliably trust on to start looking in where can I put my money and reliably expect a good return. I think you guys have covered a lot of bases on that and have a lot of activity with that. And I think crypto is also going to be even, I wish we could use the word blockchain, because when people say crypto, sometimes, if you don't understand it, people roll their eyes like, oh, it's not what you think it is. And once you get into it, and I think that is going to be one of the next waves of where you see, millionaires made in those markets, because, and already have, by the way, yeah, have already occurred. But even more growth that's going to occur over the next several years. And so getting knowledgeable on that, understanding that, and what the trends are, and these different new activities. Because when you look at crypto, it's a stock market. That's what it is. In most cases, you're investing in a company that has come up with a new technology that they're using, and they've created a coin to create that investment for it. In most cases, there are the Doge coins of the world and all that
Well, there's
stuff.
a lot of shit coins, right? Which
Yes.
they
Yes.
just, they're like a meme stock, right?
Yeah.
But
Yeah.
Bitcoin is often referred to as like a good store of value, digital gold almost, right? And that's really a supply and demand scarcity story, right? Only 21
Yeah.
million. You got like 19 and change million that have already been mined, and every 4 years the supply come into market, every day gets cut in half. So that is a supply and demand story, a scarcity story, and it's really gone mainstream now. And you have all the spot ETFs out there for it. Same thing with Ethereum. Just this past week, you get the spot Ethereum ETFs. Now, Ethereum, as opposed to like more of like a store of value play, is much more of like a utility play.
It's a
Right?
platform.
It's a network, it's a platform, and
Yep.
other platforms can build their things on there. And a lot of coins have some cool utility, but you have to be careful because there's like, I don't know, 100,000 coins out there now, and a good portion of them are bull.
Yeah.
So
Yeah. If you stay on crypto Twitter, you're going to see all kinds of stuff.
So
You got to be
like,
careful.
stick with the ones that, are either ones like Bitcoin that are well known or that actually have good use case utility. But I think it's the most exciting market. Yeah, it's kind of like a stock market, except it's currencies. So, right, like, so it trades 24/7, never sleeps,
Yes.
and it's more volatile in the stock market. So it's like a riskier stock market. But it is still, relatively speaking, pretty early, although adoption is happening at a more rapid rate now.
Yep.
And, now people that were talking bad about crypto have been flipping the script and changing their tone. And now that you have these spot ETFs out there, it makes it a lot easier for somebody to say, hey, just like I talked to my financial advisor, say, yeah, put 5% of my portfolio in gold, put this amount in emerging markets, this much in stocks, this much in bonds. Well, now I can use those same dollars in that same brokerage account and buy crypto, as
Yes.
opposed to having to go to a Coinbase or another exchange. People are worried about the keys and losing their coins. This makes it a lot more mainstream and easy, and I think a lot easier for people to get exposure and add it, especially traditional money out there that's not going to go do this, for them to get exposure to it and add it to their portfolio.
Yeah.
And it's already the Bitcoin #1 and Ethereum #2 most successful by a large margin ETFs in history, which shows you, based on the inflows, the level of demand from consumers out there. And this is still early in the adoption story. And Bitcoin at the time of this call is at 64,500. Yeah, I think that if you're somebody that wants to invest over a long time horizon, I have zero doubt that it's going to be much, 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 much higher in the years to come.
Yeah.
Now, there's going to be risk involved over that period
It's
of
gonna
time,
go
but
up
I
and down.
think it gives you the best asymmetrical risk return for your money than any other investment out there.
Well, it's already proven
And
that if you just look at the track record over the last 5
yeah,
years and what you've,
yeah, I mean, it's
there.
by far the best performing asset over the last 10 years,
Yeah.
and it's not even close.
Yep.
At some point you run out of some of that, but we're not there yet. I mean, to give you an idea, my price target just over the next year is at least double where it is right now.
Yeah.
Right, for Bitcoin. But some of the altcoins have an opportunity to more than 2x, some of them 10x, some of them
They
some are
move
gonna
with
explode.
Bitcoin, and when you see Bitcoin go up and you see the altcoins come along with it, it's a big wave of stuff, that flows. And really and truly, I'm going to put you on the spot. We're going to have to do another episode just purely on crypto, because we could do this for 5
Oh yeah.
hours and go through all this stuff, because I spend a lot of time looking into it, reading about it, and I have some money in there as well, and it's a big passion of mine, and I think that I teach my kids about it. I'm like, look, this is something that you need to be aware of, because it's going to have an impact, especially when, as a U.S. government, on a dollar, we're sitting at $35 trillion in debt. To say that you need to have another hedge against that would not be a bad thing.
Well, you know what else is I mean, we got the presidential race coming up here, but I mean, just purely looking at some of the numbers and stuff, there's at least a 50-50 chance that Trump's gonna win the election. Some would say more than that, but he is actually right now at the Bitcoin conference in Nashville.
Yep.
And it's going to be like the largest gathering of Bitcoiners in the world. There's rumors that he's going to speak and call for the US to create a strategic reserve of 1 million Bitcoin. That would be, that would be a pretty big supply. I remember there's only ever 21 million that can be created. So to have
They
a
already have
reserve
it. It's locked up in the FBI vaults from the what was it, the website that was the underground, dang it.
Oh, Silk Road? Which one?
Silk Road, yes. All the stuff they confiscated from Silk Road, they've got it still. So they've already got it built up. They just have to tell everybody.
But that can't be a bad thing, having a president and the vice president, JD. He's also a pro Bitcoiner. So if just purely, not caring if you're Democrat, Republican, but just purely from a crypto investor's mindset, certainly I don't think it would hurt the price of cryptocurrencies if you had somebody in office that was pro crypto. No. And that certainly appears to be the case if Trump were to win.
And there's countries, I mean, all around the world that have, adopted it as part of their, investment strategy
and they're doing great. Look at El Salvador. Look at other
Yep.
countries following suit. And you know what else? Companies that are adopting Bitcoin as a treasury asset have been crushing it as well. So
Yep.
you have countries adopting it and going on the Bitcoin standard, but then companies, like, one of the things that propels Bitcoin and crypto's price much higher, if you look at like ARK Invest with Kathy Wood, they got predictions on Bitcoin over like $1 million a coin. But how do they get there? Countries adopt it, and businesses, publicly traded companies, adopt it as a treasury reserve asset, which means that instead of just having cash on the balance sheet, they can hold Bitcoin on the balance sheet. And companies that have done that, MicroStrategy and other copycat ones, they are freaking knocking the cover off the ball, obviously, right? So Michael Saylor looked like a crazy guy, but boy, he's looking pretty darn smart now, making like $4 billion on his investment or whatever it is. So
he's doing pretty good. And everybody wants to point out when it takes a crash, like, oh, see what he did, and then it spikes right back up, and he's like, hey, I'm still here, guys. I'm still here. I'm still buying.
But we could go on for a long time talking about crypto, but Yeah, and listen, I think it's something that I tell people, you know, I think it's certainly a part of the future. And if you don't like it, you should invest a few percentage points of your portfolio and do
Just
it. If you
what
do, if you
here's
do, then maybe do a little bit more. But even if you don't, I think I used to be a financial advisor before doing MBS Highway. Right? In that period of time between Mortgage Market Guide and MBS Highway, I was a member of like the number one Barron's ranked financial team in New Jersey, and uh, yeah, I'm always big believer in diversification, right? So, you need to have your exposure to maybe like stocks, bonds, alternatives, maybe some gold, but I would consider having some crypto too, if not for anything else, just for some hedges.
I tell people all the time, take $100 or 50, whatever you're comfortable with, buy some Bitcoin. Okay. When you do that, then all of a sudden your attention turns to that a little bit, and you learn a little bit, and you learn a little bit more, and you pay attention a little bit more. And now you're interested in it a little bit more. And then you buy a little more, and then you look up and you're like, man, because that's what happened to me is I first found out or kind of started discovering it about 5 years ago, 6 years ago. And I started looking into it, and I'm like, this sounds like kind of a gamble thing. And I read a little bit more about it, and I read a little bit more about it. I understand the fundamentals of it, and
Mm-hmm.
how the blockchain works, and the immutability of it, and how it's kind of decentralized, and it's very difficult to hack and get into, and what it does to the middlemen and the banking system and all that stuff. And you go, wow, this has real utility. All it's missing is adoption. And what we've seen is adoption over the last 5 years that has been unprecedented. And I think, just like you, it's going to continue. And it's, and now it's very mainstream. So
Mm-hmm.
at least, for nothing else, check it out, read about
Yep.
it a little bit, get your free 30-day trial with Dan here, and on Crypto Charged, and grow your mind a little bit. You might be surprised what you find out. So, Dan, I can't thank you enough, man. This has been awesome. Like I said, we could go on for hours and hours. I love nerding out on this stuff, and I learn so much from you guys every single day. So keep up the great work. Hope your dad's feeling better. He's been going through some struggles lately and health wise. So, we're thinking about him and praying for him. So I hope he, continues fighting the good fight, because, we need him out there on that wall telling us every day where these things are headed. So
For sure. Well, Mike, thank you for having me.
yeah, it's been great. Thank you, everybody, for sticking around. I will be back on Tuesday with another market update. We'll talk about rates again, see where they're headed, and we'll keep an eye on Dan's prediction of 6.25. I'm going to hold him to
Oh
that.
boy.
I'm kidding. All right, everybody, have a great weekend.
Take care, everybody.